Hi, good morning, everybody. My name is Brianna Marquis. I am a partner in the West Hartford office. I'm also in the private clients group. So I'm very excited to be speaking with you today about some tips on successfully administering a private foundation and how to avoid some common self-dealing pitfalls. So to start, we'll look briefly at what private foundations are and how they work. So as I'm sure many of you are aware, a private foundation is a type of charitable organization that's exempt from federal income tax under Section 501c3 of the Internal Revenue Code. Private foundations qualify to receive contributions that are deductible for income, gift, and estate tax purposes. Typically, private foundations receive funding from one or a few private sources. In comparison, public charities often receive ongoing support from the general public. Generally, private foundations make grants to public charities and award scholarships to certain individuals. They aren't actually doing the charitable work. Rather, they're supporting the organizations that do. However, some foundations might actually operate a direct charitable program, and in that case, they can be recognized as what's called a private operating foundation. So private operating foundations are a little bit beyond the scope of what we're discussing today, but many of the same self-dealing issues can arise with them as well, so it's important to be able to issue spot regardless of the type of foundation that you're dealing with. Foundations can be structured either as a trust or as a corporation, and picking the appropriate structure from the beginning is an important first step in ensuring that the foundation is administered properly. The corporate structure is used when a foundation is expected to engage in activities that can expose its managers to liability. So for example, if the foundation is taking a more active role in its charitable activities instead of simply making grants, the corporate structure might be more appropriate. This structure also provides corporate governance procedures, for example, a board of directors. The trust structure, though, is chosen when a foundation will only make grants to other charitable organizations. If the foundation is structured as a trust, the drafter should ensure that certain powers are included in the trust agreement to make it as flexible as possible. The trustees could also be given the power to later incorporate if that makes sense down the line. Choosing the right charitable recipients is another way to be sure that the foundation runs smoothly. There's no requirement to name or limit the type of charities that the foundation can benefit, nor is anyone required to limit the foundation to a particular charitable purpose when it's created. The organization's flexibility can be preserved by adopting general charitable purposes in the organizational documents and then leaving non-binding written guidance and recommendations for future foundation managers regarding the particular charities and purposes that you'd like them to consider when making distributions. Some foundations are intended to last for multiple generations, so that flexibility really is key. But it's also important to make sure that the organizations the foundation supports fall within the appropriate guidelines. So for example, only certain types of supporting organizations can receive distributions from foundations and only under certain circumstances. So it's important to make sure that we're following the rules there. Another way to ensure that the foundation runs smoothly is to follow all of the relevant reporting requirements. So each year, the foundation has to file an annual return. It's called the 990-PF. That gets filed with the federal government. It sets forth their assets, their liabilities, what the income was, contributions it received, and obviously grants and expenditures that it made throughout the year. Federal law also requires the foundation to file a copy of its annual return with the Attorney General's office in the state where it's formed, the state where it has a principal office, and any other state where it's registered. Corporate form foundations generally must satisfy some additional state registration or reporting requirements in order to establish their exemption from state tax and to maintain their corporate status. So to ensure a foundation's corporate form is recognized for liability purposes, the foundation manager should always observe the corporate formalities required under state law. So that includes things like holding your directors' meetings and making sure that you take minutes of those meetings. A foundation's annual net income, so like interest, dividends, capital gains, that is subject to an excise tax that is in effect a tax on the foundation's income. If a foundation has unrelated business taxable income, then it has to pay tax on that income at regular trust or corporate income tax rates. Unrelated business taxable income is income from the conduct of an active trade or business that is not directly and substantially related to carrying out the foundation's charitable purposes, obviously other than producing income for the foundation. A foundation's debt-financed income is also subject to unrelated business income tax. That tax applies to the debt-financed portion of the foundation's income and gains from holding or disposing of the debt-financed property, whether the foundation holds it directly or indirectly. So now that we know kind of the basics of a private foundation and how to keep them running smoothly, we can look at some ways in which that things can go wrong for foundations and their managers. On this slide, we have a list of transactions that are usually considered active self-dealing when we have a transaction between a private foundation and a disqualified person. And a disqualified person is something that we'll discuss in a little bit. And these are all considered acts of direct self-dealing. Any sale or exchange of property between a private foundation and a disqualified person is an act of self-dealing. So, for example, the sale of materials by a disqualified person to a private foundation is an act of self-dealing regardless of the amount paid to the disqualified person. However, there are exceptions which we will discuss as well. The transfer of real or personal property by a disqualified person to a private foundation is treated as a sale or exchange if the foundation assumes a mortgage or similar lien that was placed on the property before the transfer, or it takes the property subject to a mortgage or similar lien that a disqualified person placed on the property in the 10-year period ending on the date of the transfer. Leasing property is usually an act of self-dealing. Lending money or other extension of credit between a private foundation and a disqualified person is an act of self-dealing. However, this does not include lending money by a disqualified person to a foundation without interest or other charges if the borrower uses those loan proceeds exclusively for purposes specified in 501c3 of the code. So it's important to note that a loan by a disqualified person to a private foundation at below market interest rates is still treated as self-dealing. There can't be any interest charged. Generally, providing goods, services, or facilities between a private foundation and a disqualified person is an act of self-dealing. This applies to things like office space, cars, parking lots, secretarial help, publications, those types of things. However, it's not self-dealing if a disqualified person provides them to a foundation without charge, and those goods, services, or facilities are used exclusively for the charitable purposes. Also, providing goods, services, or facilities to a foundation manager, employee, or unpaid worker is not an act of self-dealing if the value of the items provided is reasonable and necessary to the performance of the tasks involved in carrying out the exempt purpose of the foundation, and it's not excessive. Paying compensation or reimbursing expenses by a private foundation to a disqualified person is generally an act of self-dealing. The general rule does not apply, however, to the extent that the payments, again, which cannot be excessive, are for personal services that are reasonable and necessary to carry out the foundation's exempt purposes. So thus, it's not an act of self-dealing for a private foundation to pay reasonable compensation to a foundation manager who is, say, an investment advisor for managing the private foundation's investment portfolio. Also, paying reasonable compensation to trustees of a trust would not constitute self-dealing because obviously their services are necessary. So kind of to sum up this discussion on self-dealing, I'll point out that indirect self-dealing is also prohibited. And so by contrast, an indirect act of self-dealing is a transaction between a disqualified person and an organization controlled by a foundation. So we mentioned disqualified persons earlier, and now we'll look a little bit closer at who they are. The failure to identify disqualified persons is a very common self-dealing pitfall for private foundations. Foundation managers need to be able to identify them in order to avoid these potential self-dealing situations. So let's look at each category in a little bit more detail. So a substantial contributor is someone who gives more than 2% of the total contributions received by an organization from its inception, provided, though, that it's at least $5,000. Foundation managers include people like your officers or directors if it's a corporate form, or trustees if it's in the trust form. The next disqualified person is someone who owns more than 20% of the total combined voting power of a corporation, profits interests of a partnership, or the beneficial interest of a trust or unincorporated enterprise, which is during the ownership of a substantial contributor to the foundation. And then, of course, we have a family member of any of those people we've just mentioned. A corporation where more than 35% of the total combined voting power is owned by anyone described in numbers 1 through 4. And also a partnership where more than 35% of the profits are owned by somebody in 1 through 4. So obviously, numbers 1 through 4 are our main players. The list continues, which is why it's so difficult sometimes to identify who is a disqualified person. So disqualified persons also include a trust, estate, or unincorporated enterprise where more than 35% of the beneficial interest is owned by somebody in our original 1 through 4. And the last two deal with kind of more specific circumstances that you might not come into all too often. But when you're dealing with the tax on excess business holdings, certain other private foundations are considered disqualified persons. And for purposes of the tax on self-dealing, certain government officials could be considered disqualified persons. So obviously, this list can include a lot of different people. So it is worth saying again that it's so very important to identify your disqualified persons. So as I mentioned earlier, there are exceptions to self-dealing, which is good, but can also unfortunately further complicate the situation. So if a foundation provides goods, services, or facilities to a disqualified person, it's not self-dealing if they're made available to the general public on at least as favorable terms as they are made available to the disqualified person, and the goods, services, or facilities are related to the private foundation's exempt purpose. The term general public means those persons who reasonably would be expected to use the foundation's goods, services, or facilities, and this doesn't apply, though, unless a substantial number of people other than disqualified persons do actually use those goods, services, or facilities. Paying compensation or reimbursing of expenses by a private foundation to a disqualified person for personal services that are reasonable and necessary to carry out the exempt purpose of the private foundation is not considered self-dealing, but again, the compensation or reimbursement cannot be excessive. Personal services include the service of a broker, for example, serving as the foundation's agent, but not the services of a dealer buying from the foundation as a principal and then later reselling to a third party. If a foundation makes a cash advance to a foundation manager or employee to cover anticipated out-of-pocket expenses, that is not considered self-dealing, as long as, again, that advance is reasonable in relation to the duties and expenses required of that foundation manager. And just kind of as a rule of thumb, we typically see it considered to be reasonable if it's not more than $500. Leasing of property by a disqualified person to a private foundation is not an act of self-dealing if the lease is without charge. The lease will be considered without charge even though the foundation agrees to pay for certain things like janitorial expenses, utilities, or other maintenance costs, as long as that payment is not made directly or indirectly to a disqualified person. And again, there are exceptions to indirect self-dealing as well, and those include things like certain business transactions, grants to intermediaries, and certain transactions involving limited amounts. So we've looked at what foundations are, we've looked at all of the rules, but now it might be helpful to kind of see it all in practice. We'll take a look at some of the most common self-dealing hazards that we see. So pledges and charitable fundraising events often give rise to prohibited acts of self-dealing. A foundation cannot make a grant to a charity if the grant will satisfy a disqualified person's personal and legally binding pledge to make a gift to the charity. It's also self-dealing for a foundation to pay any part of the amount required to be paid for admission or tickets to a charity ball, a benefit golf tournament, or other fundraising event, unless the foundation declines to receive the tickets and the right to attend the event at the time it makes that contribution to the charity. Private foundations can pay reasonable and necessary travel expenses, provided that they serve the foundation's mission and charitable goals. So even disqualified persons can have their travel expenses reimbursed when they are acting on official foundation business, as long as, again, the expenses are reasonable. However, paying for personal travel is self-dealing. Often, family members enter into arrangements to share expenses with their family foundation. So the shared use of office space, supplies, office equipment, and employees can avoid self-dealing, but meticulous records should be kept to show that the disqualified person doesn't end up benefiting from that situation. The fact that a disqualified person receives an incidental or slight benefit by the use of a foundation of its income or its assets will not by itself make that use an act of self-dealing. For example, public recognition that a substantial contributor might receive that comes from the charitable activities of the private foundation, that will not itself result in an act of self-dealing, since generally that benefit is incidental and tenuous. So now that we know what self-dealing is and how it occurs, we can look at some of the potential consequences. Section 4941 of the Internal Revenue Code imposes an excise tax on acts of self-dealing and requires that the transaction be undone. So an excise tax of 10% of the amount involved in the act of self-dealing is imposed on the disqualified person for each year or partial year in the taxable period. And so the taxable period means the time beginning with the date the self-dealing occurred and ending on the earlier of either the date the IRS mailed a notice of deficiency, the date when the tax is assessed, or the date when the correction is completed. An additional excise tax of 5% of the amount involved is also imposed on a foundation manager who knowingly participated in an act of self-dealing. So the key word here obviously is knowingly. The manager acted knowingly if they either had actual knowledge of enough facts so that just based on those facts, it would be an act of self-dealing, if they were aware that the transaction under the circumstances was self-dealing, or if they negligently failed to make reasonable attempts to determine whether that act was self-dealing. And so obviously this is very fact-specific. Another excise tax of 200% of the amount involved is imposed on the disqualified person who participated in the act of self-dealing if it's not corrected within the taxable period. In addition, there's a tax of 50% of the amount involved that must be paid by any foundation manager who refuses to agree to part or all of the correction of the self-dealing act. This, however, is subject to a $20,000 limit. So the foundation must report and compute any taxes owed on an IRS Form 4720. That form has to be filed by the due date of its Form 990 PF. Each manager or disqualified person must file their form by the 15th day of the 5th month after the end of his or her taxable year. Obviously, late filings are subject to a late filing penalty. Additional penalties can also be imposed on the individuals involved in the self-dealing, and under particularly egregious circumstances like willful and repeated acts of self-dealing, the foundation could potentially lose its tax-exempt status. So, if you weren't convinced earlier that self-dealing is bad, the excise taxes, the penalties, and the potential loss of the tax-exempt status certainly, I think, prove that point. I'll quickly go over some of the other ways that foundations can run into trouble. So the first is through excess business holdings. Generally, a foundation and its disqualified persons cannot co-own a business. A foundation and its disqualified persons cannot, in the aggregate, own more than 20% of the voting stock of a corporation or the profits interest in a partnership. So these are called permitted holdings. The permitted holdings are increased to 35% if one or more persons who are not disqualified persons have effective control of the business. Under a safe harbor rule, a foundation will not be treated as having excess business holdings, regardless of how much the business is owned by a disqualified person, if the foundation owns no more than 25% of the voting stock and no more than 2% in value of all outstanding shares of all classes of stock, either voting or non-voting. The excess business holding tax does not apply to a foundation's interest in an entity if at least 95% of the entity's income is derived from passive sources, like a family-owned investment fund holding publicly traded securities. If the excess business holding rules apply, then a foundation must dispose of its excess business holdings in a timely manner in order to avoid incurring a penalty tax. So if they were received by gift or bequest, they have to be disposed of within 5 years of receipt. Excess business holdings created when a disqualified person purchases additional holdings must be disposed of by the foundation within 90 days. There is no grace period, though, when a foundation purchases excess business holdings. So again, when disposing of excess business holdings, the foundation must be cognizant of the self-dealing rules that prohibit sales to disqualified persons. There is a narrow exception which permits a business entity that is a disqualified person to redeem a foundation's business holdings as part of a general redemption offer, but the business entity can't issue a note to the foundation to pay the shares it redeems. And then next, a foundation cannot invest its assets in a manner that jeopardizes its ability to carry out its exempt purpose. The statute imposes a duty to use ordinary business care and prudence to provide for the foundation's needs. If a foundation does make an investment that would financially jeopardize carrying out its exempt purposes, both the foundation and the individual foundation managers may become liable for taxes on these jeopardizing investments under Section 4944. An excise tax can be imposed again on both the foundation and the managers who knowingly, willingly, and without reasonable cause participate in making those types of investments, again subject to certain limits. And finally, if a private foundation makes any taxable expenditures, it's liable for taxes on these expenditures under Section 4945. A taxable expenditure is an amount that's paid to carry on propaganda or otherwise attempt to influence legislation, also known as lobbying, influence the outcome of any specific public election, or carry on any voter registration drive. And again, all of these are unless certain requirements are satisfied, making grants to an individual for travel, study, or other similar purposes, and generally carrying out purposes that are not charitable. And so taxes are imposed on, again, both the foundation and on any foundation manager who knowingly and willfully agrees to these expenditures. And so that concludes my presentation. I hope it provided a bit more clarity on how to identify and avoid self-dealing issues during the administration of a private foundation. Thank you for your time and attention this morning.